When most people hear the phrase oil crisis, they hear danger and stop thinking. I understand why. For most of my life, that was a sensible first reaction. If oil spiked, the American consumer got squeezed, inflation moved higher, transportation costs spread through the system, and before long the pain worked its way into balance sheets. Purchasing power and confidence for decades, an oil shock was treated almost like a direct attack on the American economy. That old reflex is still alive in the market. It is also badly outdated. What interests me is not the headline. It is the structure underneath the headline. I have made a great deal of money over the years by noticing when the world kept reacting to the last cycle while the next cycle had already begun. That is usually where the best opportunities live. Not in what is obvious, but in what is newly true, while most people are still priced for what used to be true. That is exactly how I see the current oil panic. The world thinks it is watching a straightforward energy crisis. Tankers, choke points, emergency meetings, analysts throwing around dramatic price targets, governments talking about contingency planning, and investors immediately treating the whole thing like a universal tax on growth. But when I look at it closely, I do not see a simple global crisis. I see an asymmetric pressure event. That difference matters. A simple crisis hurts everyone in roughly the same way. An asymmetric pressure event does not. It punishes one side of the table much harder than the other. It raises costs for some people and raises bargaining power for others. It weakens one set of balance sheets and quietly strengthens another. It does not just create fear. It creates winners, losers, and a transfer of leverage. That is where the money is. I want to start with the mistake that catches most investors in moments like this. They hear that roughly 1/5 of the world's oil passes through the Strait of Hormuz, and they immediately leap to a conclusion. If the choke point matters to the world, they assume it must hit America the way it once did. They picture the old pattern: Middle East instability means oil shock. Oil shock means American weakness. American weakness means broad risk, off behavior. Then they build an investment view on that entire chain without checking whether the chain still holds. A lot of people are trading memory, not reality. 20 years ago, that chain made sense. America was far more dependent on imported petroleum. If global supply tightened, the pain arrived quickly. The economy did not just face a higher price problem, it faced a dependence problem. The country stood on the wrong side of the trade. That is no longer the world we live in. Over the last 2 decades, new drilling methods, shale development, infrastructure investment, and a slow but unmistakable energy restructuring changed the country's position in a way that still has not fully sunk into people's minds. The United States did not merely reduce dependence. It altered its role in the system. It became an energy heavyweight that does not make the country invulnerable. No major economy is invulnerable to global pricing, but it does mean the transmission mechanism is different now. That is the first rule. Do not confuse exposure with dependence. America is still exposed to higher global energy prices because oil is globally priced. When supply gets tighter anywhere, prices rise almost everywhere. That is real. Consumers feel it. Transportation companies feel it. Input costs spread. Inflationary pressure shows up where it always shows up, but dependence is different from exposure. If you are deeply dependent on external supply through a disrupted route, then you have a price problem and a physical access problem. You do not just pay more. You begin worrying about availability, rationing, inventory drawdowns, industrial sequencing, production continuity, and energy security at the state level. That is a much uglier problem than paying more at the pump. That uglier problem sits far more heavily on Asia than on the United States. Most of the oil moving through Hormuz is not sailing to America. It is sailing toward countries whose industrial systems are built on imported energy, arriving on time at scale. China, India, Japan, and South Korea sit much closer to the center of that risk. They do not all have the same degree of vulnerability, and the better prepared among them can soften the blow for a while. But none of that changes the broad geometry. The pressure lands harder there than here. That is not a political slogan. It is logistics. And logistics, in the end, decide more macro outcomes than ideology does. I have always believed that if you want to understand a serious economic event, you should ask 3 questions before you ask anything else. Who actually needs the thing that just got constrained? Who has a substitute? And who gets paid when the price rises anyway? If you ask those questions here, the picture becomes much clearer. The world is not dealing with one energy story. It is dealing with at least 3. The first story is the obvious one. Import-dependent economies face higher costs and higher fragility when a major route is impaired. The second story is the one most people underweight. Energy producers and exporters gain revenue, optionality, and negotiating leverage when scarcity appears. The third story is the most important one for investors. Markets do not reward the same countries and sectors equally during that adjustment. They reward the assets sitting on the side of the bottleneck that owns supply, transport alternatives, export capacity, pricing power, or strategic substitution. Once you understand that, you stop asking whether an oil crisis is good or bad in the abstract. That is an amateur question. You start asking where the pain goes, where the cash goes, where the bargaining power goes, and which listed businesses sit closest to that transfer. That is how adults invest. I learned a long time ago that the best opportunities often show up when people keep speaking in moral categories while the market is already moving. In economic ones, they say this is terrible or unfair or dangerous or destabilizing. That may all be true. Markets do not care. Markets ask a colder question, given that this is happening, who can convert it into revenue, margin, strategic advantage, or future control? If you want to preserve capital and compound it, you had better learn to ask the same question. The old American script treated an oil shock like a national injury. The newer script is more complicated. Higher energy prices still pinch the consumer. That part remains, but the country also now has a much larger producing base, more export capacity, more influence in liquefied natural gas, and more listed companies that directly benefit from scarcity in a way investors used to associate mainly with foreign producers. That does not mean every American investor should blindly buy anything with the word energy attached to it. That is how fools lose money in commodity moves. It does mean the country is no longer a one-dimensional casualty of the event. That is the second rule. Do not treat a changed system as though it still sits in the same role it occupied a generation ago. I have seen people ruin themselves by owning excellent observations about the world 10 years too late. The market is full of men carrying expired frameworks with great confidence. Now let us move from crude to natural gas, because this is where the picture gets even more interesting. Oil gets the headlines. Natural gas often carries the more important surprise. A large portion of global liquefied natural gas also depends on the same vulnerable regional flow. If that flow tightens, importers do not simply face a small annoyance. They face competition for replacement molecules. In a market where replacement capacity is never as frictionless as commentators pretend, terminals matter, contracts matter, shipping matters, infrastructure matters, political alignment matters. And here again, the United States appears on the stronger side of the equation. That is not accidental. It is the result of years of capacity building that many investors ignored while obsessing over shinier narratives. The market loves novelty. Real wealth is often made by understanding old industries at the moment they become newly important again. I have never had much respect for fashionable contempt. When an industry becomes boring in the public imagination, I usually pay closer attention, not less. Boring industries feed the glamorous ones. Boring pipelines move the molecules. Boring terminals liquefy and ship them. Boring producers sign the contracts. Boring infrastructure determines whether a crisis becomes a windfall for one group or a suffocation event for another. In moments like this, boring can become beautiful very quickly. That is why I do not treat the current energy disruption as a generic market panic. I treat it as a sorting mechanism. It is revealing who has supply, who has redundancy, who has pricing power, who has fragile dependencies, and who has the balance sheet to convert temporary strain into durable market share. That is the kind of event from which fortunes are built. Not because someone guessed the next week's oil print. Not because someone found a dramatic chart on the internet, because someone correctly identified the businesses whose economics improve when everyone else is forced to pay up. There is another layer here, and it is the one that makes this more than just an energy story. The route through Hormuz is not merely a shipping channel. It is a corridor of industrial continuity. If you squeeze that corridor, you do not just move an energy line item, you change factory economics, freight economics, inventory decisions, sovereign reserve behavior, and trade bargaining positions. That is when a commodity story graduates into a geopolitical leverage story. I suspect that is the part many people still do not want to see. Most people are comfortable with visible conflict. They are less comfortable with the idea that conflict can function as pressure inside a much larger economic negotiation. But that is how the world often works. Pressure does not only show up in speeches, sanctions, and troop movements. It shows up in logistics, financing costs, shipping routes, reserve allocation, and the relative pain tolerance of two trading blocs staring at one another across a table. If one side can absorb the shock better than the other, the shock itself becomes part of the negotiation. That is the third rule: never look at a choke point only as a physical bottleneck. In a stressed world, choke points become bargaining chips. When I look at China through this lens, I do not see a country that failed to prepare. I see a country that understood the vulnerability and spent years building buffers. That matters. Strategic reserves matter. Supplier diversification matters. Alternative sources matter. Long-term contracts matter. Anyone who dismisses those moves is not paying attention. Serious states learn. Serious states hedge. But a hedge is not immunity. That is the mistake lazy commentary always makes. It sees preparation and assumes the risk disappeared. It did not disappear. It was deferred, softened, and partially redistributed. If the disruption is short, the buffers work. If it is medium in length, the buffers buy time. If it persists long enough, what began as a manageable inconvenience becomes a structural burden. And when your economy is heavily industrial, export-oriented, and energy-dependent, structural burdens do not stay hidden for long. They move through margins, output, confidence, and capital expenditure. They do not need to cause a dramatic collapse to matter. They only need to alter growth and bargaining power. That is enough. I have made money in markets by refusing to wait for the dramatic headline that proves a thesis. By the time that headline arrives, the first and easiest money has usually been made by someone else. The disciplined investor gets paid for seeing the shift, while most participants are still debating whether it counts as a shift at all. That is where we are now. I do not think the right lesson is that every energy company is a gift. Some are badly run, some have weak capital discipline, some will squander windfall cash flows on ill-timed spending or foolish acquisitions, some are priced for much more than the current setup justifies. Investing is never as simple as finding the right theme and buying the first ticker that sounds related to it. But I do think the right lesson is that the old assumption that an oil shock means America automatically stands on the wrong side of the event needs to be retired. That mental model is stale, and stale models can be expensive. If you were sitting with me in Omaha and you told me you wanted to think intelligently about this moment, I would tell you not to start with fear and not to start with forecasting. I would tell you to start with exposure maps. Which economies need the route most? Which listed businesses gain revenue if price stays elevated? Which enterprises have durable logistics advantages? Which ones own export capacity that becomes more valuable when another region loses flexibility? Which ones can raise prices without destroying demand? Which governments suddenly have more room to negotiate because the other side feels the pain more acutely? That is the work. Most people do not want to do that work. They want a one-sentence conclusion. Buy this. Sell that. Panic here, relax there. That is entertainment, not investing. Real investing is usually less theatrical and more profitable. It is also more patient. One of the biggest mistakes investors make in commodity linked episodes is assuming the first move is the full move. It rarely is. First comes the shock, then comes the commentary, then comes the repricing of obvious assets, then comes the second-order repricing of less obvious assets, then comes the realization that the winners are not only the commodity itself, but the transporters, exporters, service providers, infrastructure owners, and firms whose bargaining position improved quietly, while attention stayed on the front page. By the time the market sees the whole board, a lot of the easy money is gone. That is why I spend so much time thinking about second-order effects. Anyone can see a fire. The fortunes are built by people who understand which roads close, which shops lose traffic, which insurers raise premiums, which railroads get diverted volume, and which land suddenly becomes strategically valuable because the world got less simple. The current energy stress should be understood in exactly that spirit. I also want to say something that younger investors especially need to hear. It is possible to be directionally right about a macro event and still lose money badly if you buy the wrong vehicle. Overpay, use leverage, or assume the move has to happen on your timetable. Macro truth and portfolio success are not the same thing. I have watched countless people turn a sound big picture view into a foolish personal outcome because they wanted speed, drama, or certainty. You do not need drama, you need staying power. The investor who survives this decade best will not be the one who found the loudest prediction. It will be the one who owned real businesses with real cash flows, strong balance sheets, useful assets, disciplined capital allocation, and the ability to benefit from exactly the kind of asymmetry the world is now producing. That investor will also need emotional discipline, because asymmetric opportunities are psychologically uncomfortable. They ask you to buy what sounds impolite, unfashionable, or too obvious after years of being ignored. They ask you to stop talking like a commentator and start thinking like an owner. They ask you to accept that one country's logistical headache can be another country's cash machine, and one region's bargaining weakness can be another region's quiet strategic upgrade. That is not cynical, it is reality. And reality tends to reward the people who face it squarely. When I look at the current setup, I do not see the kind of clean, universal disaster that calls for hiding under the table. I see a world being repriced by dependency. I see old assumptions being punished. I see regions with fragile import structures facing harder choices. I see American energy capacity gaining strategic importance. I see natural gas exporters becoming more relevant than the market appreciated 6 months ago. I see pressure on Asia that is more structural than many people realize. And I see the possibility that what looks like an energy story may in fact be functioning as part of a wider contest over industrial leverage and negotiating strength. That combination does not make me fearful. It makes me selective. I have often said that investing is not about knowing the future. It is about knowing what you own and understanding the conditions under which it becomes more valuable. That is all we are really doing here. We are not trying to narrate every military twist. We are not pretending to know the exact duration of the disruption. We are identifying the side of the trade whose economics improve if the stress persists longer than the consensus once assumed. That is enough. The world keeps waiting for a dramatic bell to ring before it adjusts its portfolio. That bell rarely rings. What actually happens is subtler. One route becomes more fragile. One group of importers becomes more stressed. One exporter gets stronger pricing. One set of contracts becomes more valuable. One country learns it can absorb the pressure more easily than another. One market slowly recognizes that the old map is no longer accurate. By the time people call that a new era, the investor who moved early is already sitting in it. If I had to reduce all of this to one practical thought, it would be this. Do not ask whether the oil crisis is secretly good. Ask whom it is secretly good for. That question is sharper. It forces you to think in exposures, not slogans, in revenue, not headlines, in leverage, not panic. It forces you to separate a rise in anxiety from a rise in value. Those are not the same thing. Some events make the world noisier without making your portfolio better. Others make the world more unstable while making certain assets more strategically important than they were before. This is one of those moments. I would not waste it by reacting the way the market reacted 20 years ago. I would look at the world as it is now. America is not standing in the same place it used to stand in the energy equation. Asia is carrying more of the route risk than the average investor seems to understand. Liquefied natural gas matters more than most people think. Export capacity, transport infrastructure, and energy. Linked pricing power are worth more in a world of choke points than in a world of smooth flows. And when pressure lands unevenly, the investor with the right map does not simply avoid damage. He finds where the pressure is being monetized. That is where I would want to be. Not everywhere, not all at once. Not with borrowed money, but steadily, rationally, with the patience to let the new reality travel from logistics into prices, from prices into earnings, and from earnings into long-term value. That is how wealth is built, usually quietly, usually against the mood of the moment, usually by understanding one simple thing before the crowd does. A crisis rarely hits everyone equally. And if you can figure out who it hits least, who it forces to pay, and who quietly gets richer while the world argues about what the headlines mean, you are already much closer to the money than most people ever get.